Okay, well, thank you everybody for being with us today. A little disappointing that out of 94 students, we only have 36 of you at the start of the class. That's kind of disappointing. Um, so let me just repeat a couple of things for you. Um, the work we're doing now on the IS curve, and then at the end of the class, we'll talk about something called the LM curve, as you know, is very complicated. Very, very difficult to learn this in the absence of a lot of work on your behalf. As you know, you've been a student long enough to know that you can't learn everything you need to know in any course. I don't care if this was basic knitting of sweaters, unless you actually do some practice and some work on your own part. So I've been appealing to you to do two things. Number one, this is a chapter that is loaded with symbols and equations and stuff. I've appealed to you not just to use the textbook extensively, which is, I think, absolutely essential, but to manipulate the equations in your own right. And when you do that, they will become real to you, and you'll be able to feel what it is that the author of your textbook is trying to get across and what I'm trying to get across. And number two, as I've said almost every class, the way to study for this course is to do it every day. If you were to do this for 15 minutes or so every day, and by that I mean roughly 5 or 6 days a week for 15 or 20 minutes, everything is going to become natural to you. It's a process. You can't learn this stuff in big chunks. And the next exam, which I'll talk about in 1 second, has a lot of material. And if you wait toward the last week or two to really get into this course, I worry that the grades are going to be terrible again. So I'm begging you to do continuous study and continuous work. And that doesn't mean that you have to spend every single day 3 hours every day. Come on, you all have commitments. You all have things you have to do, and most of you are taking many other courses. I get that. But 15, 20 minutes every day to look over the book, to read the chapters, to think about it, to look at the other materials I've asked you to read. Very, very difficult to learn advanced macroeconomics if you don't rely on a textbook and if you don't think about it and do the work on a continuous basis, drip by drip by drip. So that said, I've looked at a schedule for your next exam, and someone in the class was kind enough to remind me that my thinking was incorrect in that I didn't account for the fact that you have a spring break. So I have not set the date yet. It depends upon how quickly we move through the next set of materials, but I'm thinking that the exam will either be on April 7th, which is a Wednesday, or April 12th, which is a Monday. And I'll let you know when we have our next class on Monday exactly which date it is. Right now, I have no leaning. There's problems with both of the dates. But right now, you're looking at early April for the next exam. And the syllabus tells you exactly the materials we'll be covering. The test is cumulative. Somebody asked me a question today about going over the first exam question by question by question. That's a waste of time. Most of those questions are strictly fact questions. What do we mean by structural unemployment? What's the definition of Say's law? But what I would tell you to do is you have the questions, you have the answers, you have the answer key. Excuse me, go over them one by one by one. And if there is an individual question in there that you say, yeah, you chose question B as the answer, but I think it's C. And Brian Fold did that with a question, and he straightened that out and showed that I was incorrect in my answer. Well, not incorrect, that there were two correct answers. Go over it and then come into class as you do and say, before we continue, could we go over question number 34 or 32 or 19? You said it's A, I think it's B. We'll go over it, okay? So that's the story. I cannot recommend strongly enough to you that you start doing the work because too many of you are not doing it. I'm not getting questions about things that are in the textbook. And I have to tell you, there are pages in that textbook, I read it 3 times and say, what was Jones talking about there? So you have to read the textbook, you have to study the textbook, you have to play with and manipulate the equations that we see in this particular chapter on the IS and the LM curve. So with that in mind, let's proceed. I've pointed out to you that this is an important slide, and the red words and what you see underneath it really explain the essence of an IS curve. And what it's saying is that there
I
is...
asked you a question on the notes.
Go ahead.
So is the last exam out of 100, or is it going to be reevaluated?
No, the grade that you saw is out of 100. But then what happens is that whatever grade you got will be multiplied by 0.2 because it's worth 20% of your grade.
So pretty much,
Got it?
right?
Yeah.
So how many questions are going to
everything
be in the second one?
I don't know. I didn't write the exam yet, and I have to write 2 exams. I have to write one for you and one for my CCNY class. So the test is going to be longer. There's more material to cover. It'll have the same format though, with no choice. You'll answer all the questions that are asked of you. Okay, and that exam is worth 30% of your grade. Okay, so here are the underlying concepts of an IS curve. And by the way, all of this is explained in your syllabus. Okay, so here is we're talking about an IS curve, and what it is the locus of all combinations of interest rates and incomes or outputs that yield in the marketplace an equilibrium such that we get planned investment equal to planned savings. And the notion here is that you have a 2-sector model. Savings are a function of income. You may recall I talked about how extremely wealthy people obviously save more than people like you and I save. That's for obvious reasons. And that investment is a function of interest rates, that the higher the cost of financing an investment, the higher the hurdle you have to jump in order to make that investment worthwhile. Meaning, if the interest rate is higher and higher and higher, the marginal product of the capital that you are acquiring has to be higher in order to make it worthwhile. And of course, the flip side of that is that we think of investments as having all kinds of alternatives, and one alternative is not to make an investment in capital equipment at all, and maybe just put your money into a financial asset. So we look at real interest rates, and so as we'll see in just one moment again, sort of the relationship between real interest rates and the marginal product of capital is really important, because if the real interest rate is significantly higher than the marginal product of the capital you're acquiring, you don't acquire the capital, you buy the financial investment. It just makes sense. These are the choices we make all the time. These are the choices that businesses face all the time. So savings is a function of income. Investment is a function of interest rates in this particular model. Okay. Now, we pointed out here that what I just said to you makes imminent sense. So if you look at the amount of investment that you have relative to income or output, in this case, it's investment relative to potential output or potential GDP. It's going to be a function of some parameter, A bar, which is just sort of autonomous in the sense of how much investment you're going to get, and then that gap between that real interest rate and the marginal product of capital, where the B is a sense of the sensitivity of that, almost the elasticity. Why is that important? Well, suppose the gap opens wider, and so that the real interest rate is substantially higher than, say, the marginal product of capital. But investors are not sensitive to it, so that B factor is very, very small. Then the shape of the IS curve will be more vertical, just like you had when you looked at the elasticity of a demand curve. You know, when you're in economics 101, you know that when the demand curve is really flat, it's much more elastic than when it's very vertical. So we look at this very, very carefully. We look at the kind of sensitivity that's out there, because it's one thing to say that as the gap between interest rates and the marginal product widens, you'd see less investment. But how much less investment? How quickly does investment fall off? That's what the B is. And that's why the equation is written in exactly the way it is. Okay, let's go to 23. This is saying very much the same thing. If you look at the very bottom line, all we did was multiply out the various parameters, and you see some sense of sensitivity because you see the B bar in two different places. All this did was look at the algebra and multiply everything out by the Y bar T. Okay. This I just explained to you, so we don't need to see it. Let's go to 29. This is all very, very well explained in the chapter. So, as you've studied the chapter, unless you have questions about it, I'm going to assume that you understand it. Okay, so the premise here is that the IS curve is looking at the notion that planned savings must equal planned investment. But when we go to the bottom of the slide here, after doing all the manipulation of the definitions you see right up front, you see that we have private savings, which is your income minus your taxes, which is your disposable income. And then from your disposable income, if you subtract off what you spend, that's what your private savings is, because disposable income, or Y minus T, is either spent or not spent. So that's private savings. Government savings effectively are defined as budget surpluses. To the extent that taxes are greater than government spending, you have a government surplus, that's government saving. Certainly at the federal level in the US and in most of the world, that's a negative number. And then you've got what we call foreign savings, which is imports minus exports. And the reason why that's considered savings is that to the extent that you have that trade deficit where your imports are greater than your exports, that's financed by what's called a capital account, meaning money is coming into your country. So if hypothetically the US has a trade deficit or a current account deficit, say of 500 billion, it means that we are buying 500 billion more than we are, 500 billion more than we are selling abroad. That could only be done if money equal to 500 billion is coming into the US. Otherwise, how could we pay for it? That's foreign savings. So this gives you a sense of the aggregate sense of what we mean by savings.
Does the IS curve accommodate for things like crime or like extra stuff like the pandemic and stuff?
Does the IS curve account for things like the pandemic, you asked? I'm sorry, Fami, I didn't really hear you.
Like does it also take into account stuff like crime? Like if someone gets robbed, that would affect their like disposable income, right?
Not really. I mean, I don't think crime is considered to be a factor in determining the positioning of the IS curve. Now, is the pandemic built into the IS curve? Of course it is. Because if you think about it, it has shifted the IS curve. Every level of interest rates was associated in the first half of 2020 with a lower level of output. So it shifted to the left. Now we have the stimulus package, which shifts it back to the right, meaning every level of interest rates becomes associated with more output. So yeah, the pandemic has had a profound effect on the IS curve.
So would the stimulus package be considered like the hand of equilibrium from the previous definition?
Okay, so this breaks down the IS curve in very simple terms. And what it says is that a change in the real interest rate moves the economy along the IS curve. When actual output is less than potential, that's the fourth box there, and notice the symbols. Actual is YT, potential is YT bar with the bar over the y, you move up the IS curve. So what is that saying? It's just excuse me for 1 second. I'm sorry. You move up the IS curve. It means that you move to a point where you have less income and you have higher interest rates. And you see that the first box, higher interest rate. The third box, demand for investment, is lower. That's what happens. And you see that here in moving from A to B. So I won't emphasize that. Let's go to 35. Now, of course, there is a difference between moving a longer curve and having the entire curve shift. In answering Famia's question, which was a very astute question, the answer involving the pandemic obviously involves a shift in the IS curve. So in this case, what your author is assuming is not a pandemic, but some incredible improvements in technology so that you get an investment boom. And we saw a lot of that. That's why the growth stocks had done so well in previous years. It's why, really, I've said to you many times, you're in the midst of the greatest industrial revolution the world has ever seen. And what that's saying is that you end up getting more income for each level of interest rates. Each level of interest rates becomes associated with a higher level of income. Each level of interest rates becomes associated with more savings. And I've pointed out to you that the savings rate has just spiked. And we have much higher savings rates than we had in terms of the long-term trend in savings rates, which in the US was around 3 or 4%. Then it moved up to 5 to 6. And right now, at least temporarily, we're well above 20% as a savings rate. Okay. And just one or two more, and then we'll go on to new stuff. And this is what we mean by a shift in the IS curve to the right. So here we have a technological revolution where each level of output is associated with a lower interest rate, or each interest rate is associated with a greater level of output. Okay. And finally, a change in R is a real interest rate, comes out as a movement along the IS curve. The curve tells you the level of short-term output that corresponds to every interest rate. Any other change in the parameters of the short-term model causes the IS curve to shift. This says case study, but what it really is a summary. It's a conclusion that you want to live with. So it says case study, but what it really is the conclusion that you draw from the first 36 slides or so that you saw dealing with IS curves. It's very important because what we really want to see happen is you want that IS curve to be moving as far to the right as you can, because it's saying that for every level of interest rates, you're getting more output. And lo and behold, that is exactly the kinds of things we saw in the years between the great financial crisis that ended, who knows when, 2010 maybe 2011, no one has an exact date, and the start of the pandemic, where interest rates were at historic low levels, but the economy was growing beautifully. And we drove we drove cyclical unemployment almost completely out of the economy. It was gone, virtually saying that anyone who wanted to work could find that work. Now, frictional unemployment remains, structural unemployment remained, but it became very difficult to argue that there were terribly many people who were out of work simply because the economy wasn't strong enough. So we got back to our natural unemployment rate, which was somewhere in the low threes, maybe 3.4 or so percent of the labor force. And that's a phenomenal outcome, but that comes when your IS curve shifts to the right. Okay. So let's carry on with new material, unless you have any questions about that stuff. Okay. So I was watching Bloomberg TV this morning, and they were interviewing a former governor of the Federal Reserve Board, and they were talking about the answer to the question that the correspondent had, which was, to what extent are we going to be experiencing multiplier effects from the stimulus package? It's a real concept. I gave you an article, actually two articles that are posted in this section on the IS curve in your readings. I hope you've read them. And both of them discuss the concept of multipliers. So what is the concept of a multiplier? Which I assume you saw this in Economics 101 when you talked about consumption and marginal propensity to consume. But here we're talking about the marginal propensity, in effect, for people to take increases in income anywhere in the economy and spend it. So it's not just consumption, it's overall. It's because we're looking at the entirety of the IS curve. So when we look at that X bar, that's what that is. It's sort of a marginal propensity to spend. And when you see 1 over 1 minus X bar, that is clearly what we refer to as a simple multiplier. It can be no simpler than that. I wrote this out for you, and I hope you'll find it helpful. It's a simple multiplier. What does it say? It says, hey, whenever there is more spending, like that issue that we had just a few minutes ago, where there's a technological boom, and that technological boom results in more spending on investment items, capital equipment, either tangible or intangible. The impact on the economy tends to be far bigger than the expenditure that was made on that capital. So hypothetically, if $1 million was spent on capital, the impact on GDP won't be $1 billion. It's going to be bigger than that because the money keeps changing hands. Remember, there's velocity out there. We get bang for the buck. So what happens? Well, if you assume that the X is somewhere between 0 and 1, so it's a fraction of a whole, you say to yourself, okay, the spending takes place, it gets earned by some company, and then that company takes that money and to some extent it spends it. And the propensity or the tendency of that company to spend it will determine what portion of that money actually does get spent. That's what the X is. That's that proportion. Well, someone receives that money that the company spent, and that could be another company or it could be a person, and then that person will do exactly the same thing. Take that money and to some extent spend all of it, part of it, none of it. They'll have some propensity to consume. But when you look at that X in the aggregate, what is sort of the average number for the entire economy? As I said, it falls between 0 and 1. So it's a fraction of 1. That becomes the basis on which we end up with a multiplier. And since it is between 0 and 1, when you look at the denominator of the fraction 1 over 1 minus x, the denominator of the fraction is going to be less than 1. So let's say hypothetically it was 50%. So 1 minus 0.5 is 0.5. 1 divided by 0.5 would be 2, and you would say the multiplier is 2. And then you say, all right, that gives us a sense of how far the IS curve is going to shift. And that's why we multiply it by that equation for the IS curve, A bar minus B bar. There should be a bar over the B. A bar minus B bar of RT minus R, etc. That's how far the IS curve is going to shift. The problem with that simple multiplier concept is it's critical. And that is, we don't really know what the multiplier is going to be at any moment in time. When Congress passed, or I should say when the Democrats passed the stimulus package, they really couldn't guess. They certainly couldn't estimate what people were exactly going to do with the money. Some of you may have already received, or some of you will receive, or your household will receive some of that money. One of the things we know is that humans will always surprise you. Will people become scared and not spend the money that they get? Are people so strapped for funds that as soon as they get the money, it's like it burns a hole right in their pocket? They have to spend it immediately. They have to pay their rent. They have to pay the tuition bill. They have to pay for food. They have to pay for transportation and clothing and childcare, et cetera, et cetera. So all of it goes out, in which case the X that you see here is 1.0. We don't know. And it's hard to figure, but it's something that is absolutely critical. What we do know, and it's coming up now, is that income that people earn is taxed. That's a reality for all of us. We don't spend what we earn. We spend what we earn after taxes. So we all know that when we get paid every 2 weeks or whatever it is, it's not our hourly pay rate times the number of hours, because Uncle Sam is going to take his portion, and you're going to have federal, state, city, Social Security, Medicare, 5 right off the top that are going to take their chunk. So what do you do with what's left over, which is your disposable income? Again, we're never really quite sure. We try to estimate this because we try to figure out what a fiscal move like the package that Congress passed just a week ago is going to have on the economy. But what that does do is when you start to account for taxes, the multipliers become smaller. And that's when you get to that second multiplier, which is called the tax multiplier. And here is how you interpret the tax multiplier. You can see it's 1 over 1 minus, and then in brackets you see x bar times 1 minus t. 1 over 1 minus the propensity to spend, that's the x, 1 minus t, the share of income left over after taxes is 1 minus t. Why is that? Because the tax rate is also between 0 and 100%, between 0 and 1. So it's 1 over 1 minus the propensity to spend, the portion of income left over after taxes, which is 1 minus t. And I give you an example of that. If x bar is 0.9 and the tax rate is 0.2, when you do the math, it turns out that that multiplier is 3.57. Why is that important? Because if there were no taxes and it was the simple multiplier, 1 over 1 minus x without taxes, and x bar were 0.9, that multiplier would have been 10. So the multiplier drops from 10 to 3.57 when you have a tax rate of 20%. That's what the numbers are telling us. That's profoundly different. So we have to look very, very carefully at how fiscal issues play into this, both in terms of the spending side, which would move the IS curve to the right, and the tax side, which would move the IS curve back to the left. Because remember, you multiply the multiplier by the equation for the IS curve. So the multiplier shrinks when we have taxes. Of course it does. Because if I earn something and then part of it gets taxed away, whatever is left is the decision I have to make as to what percentage of that I'm going to spend. The multiplier in this particular case drops from 10 when x bar is 0.9 to 3.7 when x bar is 0.9, but the tax rate is 0.2. I would heartily recommend, you have the equation here, you have the data, you have the answer at 3.57. Take 5 minutes of your time, just don't even take 5 minutes, and do the math for yourself. Okay? And yes, you will be asked to calculate multipliers on your next exam. Then there's a concept of a balanced budget multiplier, which is actually a misnomer. It has really nothing to do with balanced budgets, only in the sense that someone might ask a question that says, okay, suppose the government wanted to spend $1.9 trillion and said, we're going to finance that $1.9 trillion by raising taxes by $1.9 trillion. So that whatever the expenditure is, we raise taxes by a comparable amount to pay for it. Now, there is a concept of that in budgeting, which we will go over in a few weeks, called pay-go or pay-as-you-go, where for individual spending programs, you have to find the funding. So if the government wants to spend another $10 billion on an infrastructure project, let's say they want to spend a certain amount of money to build an auto train to take us from Manhattan to LaGuardia Airport and have a train to do that, and they say, okay, that's going to cost $1 billion to do that, and they say, okay, then let's raise taxes by $1 billion. That's what we're talking about. Well, when we look at the mathematics of that, which I'm not going to give you, the concept of a balanced budget multiplier is that that multiplier is 1. So if you spend $1 billion and you finance it by taxing another $1 billion, GDP goes up by $1 billion. In this case, your IS curve shifts to the right by $1 billion. That's all we're talking about here. 3 different concepts of multipliers, a simple one, a tax one, and a balanced budget multiplier, but they're all really important because in the end, it could very well be that you've got, say, a government that says, you know, really what I'm concerned about is none of this inner workings stuff. I would like to see by the end of the year a GDP of X dollars. How much do I have to spend now in order to get a GDP of X dollars? Well, you say, well, okay, X dollars means you want to increase your GDP by a trillion. Well, you don't have to spend $1 trillion. You have to spend a fraction of $1 trillion because you have a multiplier. So spend a fraction of $1 trillion and then let the multiplier bring you to $1 trillion. That's the concept of a multiplier. Okay? Any questions about that? Okay. Let me just back up one. We're going to do this at a later date as well, so I'll skip it. So one more time, what is the concept of a multiplier? The concept of a multiplier says that every expenditure that's made results in a change in national income. But the change in national income tends to be larger than the size of the expenditure. So if you spend $1 billion more, the impact on the GDP is likely to be more than $1 billion. So if you spent $1 billion, the impact on the GDP is likely to be larger than $1 billion. The only exception to that would be if you increase taxes to pay for the $1 billion that you spend, then it would be an impact of $1 billion. Why is it called a multiplier? Because it says that each dollar that you spend, as it works its way through the economy, gets multiplied. Why? Because a dollar is spent, someone earns it. When they earn it, they take a portion of that and they spend it, which means somebody else is earning. So now you've got the $1 billion that you originally spent, plus whatever the second person just earned, and then the second person spends, and someone else earns that. So now you got the original $1 billion, you got the portion that the second person earned, now you've got the portion that the third person earned, and when you carry that all out, the impact on the GDP tends to be more than the original $1 billion that was spent, unless you have a balanced budget multiplier where the original money that was spent is balanced off against a tax increase. That's the concept of a multiplier. It's really profound, and it's actually quite good. It makes targeting a GDP number a lot easier, because if you want the GDP to go up by a certain amount, you don't have to spend that amount. All you have to do is spend a fraction of that, and then as that spending works its way through the economy, you will get to the number that you're targeting. Okay? Okay. So basically what I've been talking about with you has been really implicated in terms of government spending to try to push the economy forward. We know that not all spending is government. We know that businesses buy capital equipment. We call that investment. And that investment would also move that IS curve to the right. But we also know that the government could move the IS curve to the right. And we've talked about the fiscal stimulus package being one of them. The thing about fiscal policy, though, is that some of it can be discretionary and a lot of it is automatic. Automatic, meaning you don't have to constantly ask Congress to make decisions about spending and taxing. Laws have already been passed. They're on the books. They stay there unless Congress wants to change them. And so things like Medicare, Medicare was passed in 1964. It's a health insurance policy effectively for senior citizens. Now, there have been adjustments to the Medicare system, but it's on the books. But what it really says is that people who qualify, in this case by age, and having applied for it because they hit the proper age, get this benefit, and Congress doesn't have to do anything. Or unemployment insurance is on the books. Now, we know that they've modified unemployment insurance programs during the pandemic, but if you were to lose your job, it's there for you, automatically there for you, assuming you lost your job for reasons not of your own choosing. In other words, you didn't quit. You're entitled to that unemployment insurance. It's a transfer program. No new output is created, but you are entitled to that income. And what that income does is it tends to stabilize the business cycle all by itself, because if people are collecting unemployment insurance, then frankly, it's less likely, I'm not saying unlikely, but less likely, for example, that they're going to be tragically poor and can't afford to buy anything because they are getting unemployment benefits. If they're getting these benefits, they're going to spend some of it, if not all of it. And when they do that, that stabilizes the economy. So we have automatic stabilizers. And oftentimes the stabilizers come in forms that you don't even think about. You have a progressive income tax system. So when the economy is going really, really well, more and more money is taken away from people in the form of taxation. Not because they've done anything wrong, actually, but because they've done things right. And so that money is taken away from them, and some of their wealth is extracted from them so that their boom becomes less of a boom. On the other hand, it works the other way. When the economy is doing badly in a progressive income tax system, people's taxes fall. And if they're paying less out to Uncle Sam in taxes, they have more money to spend. It makes the drop in the economy or the depth of the recession less severe because their taxes have become less. And so we look at this really, really carefully. And so we know that fiscal policy can be automatic and it can be discretionary in that sense that it can be special programs like we've seen Congress pass during the first 100 days of the Biden administration, all of which are designed to move that IS curve to the right. Okay. Ricardian equivalence. This is a concept that has been taught in economics forever. And once you understand Ricardian equivalence, you are sort of on a pathway to understanding behavioral economics, how human behavior and psychology play into economics. The University of Chicago has the most Nobel Prize winners in economics, and for good reason. They have had a brilliant set of economists over time. But what is unknown is that the school with the second most Nobel Prize winners in economics is a school most people haven't even heard of, George Mason University. And George Mason specializes in looking at behavioral economics, that linkage between how people think and what they do sort of from a behavioral perspective and how they behave in the marketplace. So here's the point of Ricardian equivalence. And this is, again, something that we're playing with right this very moment in the economy and why it makes forecasting the economy now so difficult. And part of that forecasting is how big is are these multipliers going to be? What is the propensity to consume? So here's the point. Ricardian equivalence. Congress passes major legislation giving people a lot of money in relative terms, more than they have ever given directly to people ever before, which is what we're having now. And some people turn around and they say, I'm not going to spend that money because I know what's going to happen. They're going to turn around next year and raise my taxes, and I need to be able to pay my tax bill. So where's the equivalence? Well, on the one hand, you've got this benefit. On the other hand, you squash the benefit by saying, I'm just not going to use it. That's the equivalence. And this happens all the time. The greatest example of that happened in 1981, the first year that Ronald Reagan was president of the US. And it actually involved Queens College, believe it or not. Here's a case of Ricardian equivalence. When Ronald Reagan became president in 1981, he tried to push through, and then ultimately did, what was at that time the largest tax reduction in the history of the United States. It was called the Economic Recovery Tax Act of 1981. And it was debated in Congress and came to the floor of Congress for a vote during the summer of 1981. I was teaching macroeconomics, believe it or not, at Queens College in the evening during the summer of 1981. And I got a call from ABC News saying, we would like to come to your classroom with cameras and a TV set and be there as your students in macroeconomics watch the vote in Congress on the Economics Recovery Tax Act, and then immediately get the reaction of your macroeconomics students, which is exactly what happened. When I told my students that night that they were going to be on TV, it was like they just ran out of the room. Everybody was going to the men's and ladies' room to comb their hair and to do all kinds of stuff, put on makeup and all of that. Well, ABC came and they recorded my class, and my class got involved in that. But what's important about that was that tax cut came, and the marginal propensity to consume the Economic Recovery Tax Act was less than zero. Now, remember, I said it's always between 0 and 1. Well, here was an exception where it was less than 0. What does that mean? If people got a tax cut of $100, they saved $105 more. They say, I don't get that. What happened was people were so afraid that it was going to be reversed, which is exactly what happened the next year when Congress passed the Tax Equity and Fiscal Responsibility Act, when they reversed the Reagan tax cuts. But people got it exactly right. They said, they give me $100 in tax cuts, I have to save $105 more because I guarantee you they're going to turn this around next year. They were just so suspicious of this tax cut that they ended up saving more, and the marginal propensity to consume was negative. The marginal propensity to save was greater than 100%. That's Ricardian equivalence par excellence. I can't think of one example even better than that, where you get a gain on the one hand and you offset it with an expectation behaviorally that it's going to be reversed. That's Ricardian equivalence. It's fascinating. Okay. Let's just skip ahead to something really, really important. Okay. Now, you've seen this slide before. We have talked about demand for money. These were the motives that Professor Friedman, Milton Friedman, said are the 3 reasons why people tend to hold on to money. Obviously, to make transactions, to buy and sell stuff. For precautionary motives, meaning just making sure that they have some liquid assets they could spend just in case. And I told you that when I taught, as I did for so many years, when I taught not only about behavioral finance, but I taught personal finance, I told them that investment planners will tell individuals that they should always have set aside roughly 1/3 to 1/2 of what their annual expenditures are. So if in a typical year you spend $20,000, you should have put aside no less than, say, 7 or 8,000 and maybe 10,000. Just set aside one block of 10,000 just in case something happens, in case you become disabled, in case there is a human tragedy, in case there is an act of God of some sort, a hurricane, a tornado, or something like that, where you've got money set aside, or a pandemic where you lose your job, you have to have some money set aside. That's the precautionary motive. And then the speculative motive is you're holding on to money because either A, you intend to spend it soon and you don't want to lock it up in anything where you lose liquidity, or you are looking for an opportunity. Suppose the stock market has taken a beating, as it is today. Suppose the stock market is taking a beating. You want to hold on to your cash because you go, I'm going to wait for the market to go even lower. And when it goes even lower, I'm going to say, Steve, buying opportunity. Get in there and buy like crazy. That's the speculative motive. So this is what Friedman looked at. You'll see why I'm talking about this again for you and how this comes up in something called an LM curve. And what I did was I created a slide, which is very, very similar to the slide I created for you for the IS curve. And here is sort of the counterpart to the IS curve, which stands for, of course, investment and savings. It's very much a part of the real economy because it involves investment and the like and fiscal policy. And then LM, which is liquidity and money, which is that second flow in the circular flow diagram, which we've talked about. Why is the circular flow diagram so critical? Because it's got the two flows, the flows from the real economy and the flows from the financial system that give us a whole economic financial system interacting with one another. So here we go, basic concepts of an LM curve. So excuse me, I'm going to read this just again in the interest of accuracy. And please stop me if there's something said here that you just don't get, okay? You will not be impolite. You will be doing what's very important. There is a difference between being selfish and being self-centered. Someone who is selfish when all they do is think about themselves and they take as much as they could get for themselves and they don't really care about the people around them. That's selfish. They won't share. It's the proverbial story of the person who is always at dinner, the one who grabs, the biggest, nicest looking piece of fried chicken. That's the selfish person. But the self-centered person, you all should be self-centered. You all should be saying, hey, if I don't take care of me, nobody else is going to. I need to be self-centered. I do this because it's in my best interest. And it's in your best interest to ask questions. So be self-centered. It's fine. You have a question, you ask it because you need to be self-centered. You're trying to get an A in this course. And even more importantly than that, you're trying to learn the material because that's ultimately what you leave with. It's what you paid for. So for our purposes here, assume that economic agents hold money in a liquid form for only two reasons, transactions and speculation. Now, remember, Friedman said that there's third reasons, transaction, speculation, and precaution. Here, just as we looked at a two-sector model when we did IS curves, now we're looking at two forms out of three for the demand for money. Transactions, so that we could buy stuff. Speculation, so that we could buy stuff later, okay? Assume as well that the aggregate supply of money doesn't change with changes in income and interest rates. That's a huge assumption, ladies and gentlemen, because as you know, we have an elastic money system. And if you have an elastic money system, remember I talked about elastic, how you take a deep breath in and hold it, the elastic band around your waist expands, and when you exhale, it comes back in. Well, the amount of money in the economy grows automatically with the economy because there's more deposits, which result in more credit, which results in more spending, more earning, more deposits, more credit, more spending, more earning, more deposits. Summation of all deposits is the money supply. So this is a very heroic assumption. It's not realistic. It's overly simplistic, but it's one that we have to make to understand an LM curve. So assume that the aggregate supply of money doesn't change with changes in income and interest rates. Point number 2. The level of speculative balance held by economic agents is assumed to be negatively correlated with interest rates. As interest rates go up, basically, the amount of money you hold for speculative purposes goes down. Of course that makes sense, because what are you waiting for? You know, if interest rates go up, eventually they're going to go up to some level and you're going to go, you know what? It doesn't pay for me to keep this money out of the markets. I should go into the markets. I know personally that I'm waiting for the interest rate on U.S. Treasury securities to get up to a certain level. This is me personally as an investment strategist for me and for my clients. And once that occurs, I'm pulling money out of the stock market and I'm putting it into treasuries. I will probably be late because that is exactly what's happening nowadays. Because as the interest rates have moved up, and the 10-year, at the start of this class, the 10-year treasury was over 1.65%, which is a number we haven't seen in years. Ladies and gentlemen, what's happened is that the growth stocks, the technology stocks, the stocks that are on the NASDAQ have just gotten clobbered. There's a very high correlation between the interest rates on treasury securities going up and the demise of the NASDAQ. So I'm saying I'm probably late, but what I'm waiting for is interest rate to get up to a certain level, and I'm going to reduce my holdings of stocks and put more money into bonds. That's what I'm going to do. Now, it's illegal for me to tell you what interest rate I'm targeting. I can't give you that. But I have in my mind a certain level, and I'm going to go, that's it. I'm going to de-risk. I'm just going to take the interest rate I could get on that. You know, and you think about it, you know, if you're my age, you know, 114 years old, you know, if you're my age, you think about de-risking and you look at that. The point here being, my speculative balances are going to drop as interest rates go up. The higher the prevailing interest rates, the less incentive there is to hold liquid balances. Like, why would I hold something as a cash equivalent? Why would I keep money in a checking account or something like that, which pays next to nothing? If I could put it into a bond, let's say, and get some significant interest rate, significant being however you define it. I have significant in my own mind. It might be different from what you think. Point number 3. Since we're assuming money's held for only 2 reasons, transaction and speculative, you could think of the combination as being a budget line. So you have a certain amount of money. You could have 80% of it in transactions and 20% in speculative, 90% in transactions and 10% in speculative, 50% in transactions and 50% in speculative. That's what a budget line is. It has to add to 100%. So we now could ask, what level of interest rates would be consistent with economic agents holding various sums of transactions purposes only? What interest rate would be consistent with there being 0 speculative balances? Since consumer spending is a function of income, then demand for transactions balances can be assumed to be a function of income as well. Of course, think about it. Rich people spend more than poor people do. It's as simple as that. They make more transactions. Rich people spend more than poor people do. They have more money. So of course transactions are going to be a function of income. You know, if your entire income is predicated, say, on the minimum wage, the amount you're going to be spending on housing is going to be less than somebody who really makes a fortune, maybe someone who is a currency trader for Goldman Sachs. They're going to be looking at different kinds of houses. You know, I saw a house on the news yesterday that Derek Jeter is selling. I didn't know that his grandfather, as it turns out, was extremely wealthy and had a mansion in Orange County, New York. You should see this mansion. Oh my goodness, it's like the size of Windsor Castle. Somehow Derek Jeter bought this mansion years ago. He's put it out on the market for sale. at a bargain price of 12.5 million. He originally asked for 14.5. He's asking 12.5. And let me tell you, for the amount of land and the size of this property, 12.5 million is actually looks like a bargain to me. I mean, I couldn't afford it. I don't know if you could, but I certainly couldn't. But when I look at it, you know, he obviously can spend way more than we can. How do we know? He bought a baseball team. He bought the Miami Marlins. So he put up more than $1 billion to buy a baseball team. So rich people are going to spend more money than poor people. Okay. Now comes the red ink, the key to the LM curves. For each level of interest rates, there's going to be a level of income. Same start we had with the IS curve. Now, instead of having for each level of interest rates a level of income that will make aggregate saving equal to aggregate investment, here we have for each level of income, there's a level of interest rates that will make aggregate demand for money equal to the aggregate supply of money. Now, there's a notion here that the aggregate supply of money is fixed. It's unrealistic, but that's the assumption. We would expect that as the level of, that the level of income that would equate the demand for and the supply of money would be higher the lower the interest rates, or lower the higher the interest rate. Because it's all about transactions demand in this assumption. So higher levels of income are associated with higher interest rates. If income rises, transactions demand for money also rises. Yes, and the speculative demand therefore falls. To make transaction balances rise, there has to be a reduction in speculative balances. Economic agents will have an incentive to reduce their speculative demand when interest rates go up. So we now know that an LM curve has to be upward sloping. And this is the derivation that goes back to my Queens College days as an undergraduate when I was, how old was I? I guess I was 17. I guess I was 17 years old when my professor put these charts on the blackboard in room 306, and I kept it forever. So what you're seeing is a picture that came right out of my Economics 201. In those days, we called it Economics 6, but my Economics 201 notebook. This was my actual notebook page. And you can see in B, the budget line, that the totals, have to add together for the transaction demand and the speculative demand. If you go to C, that transactions demand rises with income, and you drop down and you create an upward sloping LM curve. End of story right here in a chart that unfortunately has 1 million words and has to be studied, ladies and gentlemen. This is not going to come easily to you. So you need to study this chart really carefully. I will explain some or all of it now, but it requires your work, okay? Very hard to understand what's going on here if you don't do that. So here we have put IS curves and LM curves on the same chart. Now, if you go to what I called zone 1, which is on the bottom left, you see here the IS curves crossing a horizontal LM curve. And then what happens is, let's say you have a technological advance, so you have an expansionary fiscal policy, and the IS curve shifts from IS1 to IS2. Notice what happened in this case. Income went up, you moved along to the right, no impact on interest rates. And what this is saying is that there's so much liquidity out there that this fiscal policy actually had no impact on interest rates. Ladies and gentlemen, what you're looking at here in zone 1 would be reminiscent of the US economy in 2019. Interest rates didn't move, spending did, and we moved along that LS curve from where you see IS1 to IS2, meaning we moved to a higher income and we seem to have no impact on interest rates. Now, when we are extremely liquid, we have a concept called a liquidity trap. And someone asked the question, it was in my other class actually, she asked the question about liquidity traps, especially as it pertained to Japan. And the question is really quite astute. When you're in a liquidity trap, the central bank can increase the money supply, can increase the balances available for transactions, precautions, and speculation, and nothing happens. The money just sort of sits there and doesn't go anywhere. MV equals PY, and the V, or the change in velocity, is zero. Nothing happens. The velocity is so low that the money effectively doesn't turn over. You get no bang for the buck, and you are trapped in a liquidity. You are trapped in what's called a liquidity trap, where monetary policy can't help you. Interest rates are already as low as they're going to go, and there's already so much liquidity out there that if you have an expansionary monetary policy, it doesn't do anything. What this reminds us is that if you use an expansionary fiscal policy and shift from IS1 to IS2, at least you'll get some economic growth. What the Japanese did not do between the 1980s until well into this century is engage in stimulative fiscal policy. And because of it, their economy just languished for decades. What this is saying is that when you've got so much liquidity out there, adding more liquidity doesn't help you. What it does is it creates an LM curve that starts out horizontal and then moves along as you see as the way that dotted line is. Look, it just extends out to the right. Nothing happens. What you're really hoping for is for your LM curve to have some vertical section to it. That's zone 2. And here, when you're in zone 2 and you have a vertical portion to your LM curve, when you have an expansionary fiscal policy, that becomes associated not only with more income, which is what you're shooting for, you want there to be more growth, but you end up with more interest rates. Ladies and gentlemen, that is exactly what the financial markets are fearing right now. Financial markets are fearing that our IS curve is crossing our LM curve on a vertical section, and we are going to end up, yes, with more national income. That the second half of this year, the economy is going to grow at numbers that are more like China's numbers, 7%, 8%, 9%. Nobody really knows. Really beautiful numbers, but interest rates are going to continue to go up. And so the Federal Reserve has the second day of its 2-day meeting today. They will make an announcement at 2 p.m. as to what changes, if any, to monetary policy are going to happen. And then at 2:30, the chairman of the Fed, Jerome Powell, will have a press conference at 2:30 today, which of course I'm going to watch. And he's going to have to address questions about interest rates going up. And why are interest rates going up? They're going up because there's more fear of inflation, Fisher equation, and there's more fear of real economic growth happening. So the real rate is actually moving up a little bit too. And so basically the questioners, who are journalists, are going to be asking, well, we have this big fiscal push, which shifts the IS curve to the right, and it's going to be crossing a more vertical LM curve. Aren't we going to get real economic growth, but it's going to come at the cost of higher interest rates? That's exactly what you're looking at in zone 2. Realistic? You bet. It's happening right before our eyes today. It's conceivable that you could have a situation like zone 3, where the LM curve is vertical. And so what happened? Well, we expanded the money supply, so the LM curve shifted out, and you got that dotted line, and it moved to LM2. And then you get a massive fiscal policy. And all that really happens here is that the IS curve shifts, but it shifts up vertically. What is that saying? It's effectively saying that in the end, you end up with higher interest rates but no economic growth. And that would occur when the economy is at its capacity limits, when we are just simply not capable of producing anymore. We are producing way above potential. We just can't do anymore. What do? You get higher interest rates because of more inflation fears, because the real rate of interest rises. But you don't get any economic growth because we're at capacity. All of this is saying to us that the circumstances under which we look at this being IS curves relative to LM curves, really makes a difference. And even though this is a static analysis, it's really very helpful in us trying to figure out what happens to the two variables that most people are concerned about. Number one is GDP. That's on the real side of the economy. And on the financial side of the economy, it's interest rates. And so this is very helpful to us. It's a static analysis that's been in existence for, gosh, I don't even know. I mean, obviously, I studied it in the 1970s when I was in college. So there you go. So it's been around a long time. And it continues to be in textbooks. When you get to graduate school, and some of you have told me that you are going to graduate school in economics, you've asked me to write letters for you. When you get to graduate school, you take the IS and LM curves and you use the mathematics based on the equations that we have here, and you turn it into a dynamic analysis, which means you mix it with econometrics to try to figure out the answers to the questions: what happens to income? What happens to interest rates? This is static. It's showing a shift. That's it. But no consequences to the shifts. It just shows you the outcomes of the shifts without the consequences. When you get to graduate school, it's more dynamic, and you use econometrics to figure that out. And so that's effectively it, ladies and gentlemen. This is our study of IS and LM curves. There are in here, in slides 67, 68, 69, which I'm not going over, there are questions and there are answers. You might want to look at them as a test for yourself of your understanding of this. And so it takes us to our homework. I'd like anybody who would like to contribute to the class to maybe take a dive into question number one. Explain in detail what information is conveyed by an IS curve. By now, it should be right on the top of your mind. Anybody? What's an IS curve? What's the information conveyed? What have we been doing for 2 classes? What have you been studying and reading and doing homework about? And going through this PowerPoint presentation 15 minutes a day for 6 days a week. Nobody? Nobody can talk to us about information conveyed by an IS curve? Don't be shy. You're going to make me cry. Okay, so an IS curve tells us all of the combinations of interest rates and incomes consistent with bringing planned investment equal to planned savings. Thank you, Sujan. Yes, all the combinations of interest rates and incomes consistent with bringing planned investment equal to planned savings. Understanding that investment is a function of interest rates, savings are a function of income. How would an IS curve shift if the federal government has this fiscal stimulus package? It will shift to the right. Of course, you're going to get more income for every level of interest rates. If the propensity to consume of households increases and businesses choose to build more capital, same thing. Same thing. If the money supply increases, no effect. No effect. Unless the money supply increase results in some change in real income. Remember, MV equals PY. So if you have M changing on the left side of the equation, something has to happen on the right side of the equation. You're either going to get more inflation or you're going to get more real economic growth, or some combination of the two. That's what happens if the money supply increases. One of the things that maybe you can extract from this last answer, and it'll be the last thing I say today, is notice how the individual chapters that we're covering link with each other. You know, what I just said about MV equals PY equals nominal GDP came out of the inflation chapter. And so it's so important for you to study. You have to study. And part of studying is manipulation. You know, look at any child. I don't know, maybe some of you are early elementary ed or even secondary ed majors or minors. But look at any child. And I'm not, believe me, I'm not saying your children, please. I don't want anyone to get insulted. Look at any child and how much they learn through manipulation. They pick stuff up, little babies, you know, they pick it up. They move it around in their hands. They put it in their mouth. They see what it tastes like. They squeeze it. They throw it. They kick it. They manipulate it in all kinds of ways. That's how they learn. Ladies and gentlemen, that's how you learn too. Manipulate those equations. See what they mean. Do what ifs. You know, what if I move this over here? What would it look like? Very, very important. As I pointed out, the very first class, and I've said it over and over again, this is a quantitative study, macroeconomics. And that means you have to play with equations. And so I'm asking you, I'm begging you, because I really want your grades to come up on the second exam. Work with these PowerPoint presentations. Work with your book. Read the things I've asked you to read. Manipulate those equations and do the work that you didn't do, apparently, many of you, in trying to understand the solo growth model, where I said to you, you have to work with this yourself. You have to see why it is that you stop investing at the point where investment is just there to replace depreciated assets. Look at the shape of the curve. Look how the tangent is exactly parallel to the depreciation line. All of these things that we pointed out, you have to do yourself. Repetition, repetition, repetition. Okay, so we will have class again next week, and then you'll have the benefit of having a week off to decompress or to study more, depending on your preference. So let's call it a morning, and let's get back to work on this, and let's move forward. Now, the next work we're doing is on the Federal Reserve. And I can't even tell you how difficult and how easy the Federal Reserve is, because we're talking about money. Why is it easy? Because the information about the Fed is everywhere. It's everywhere. Just go to the website of the Fed. Go to federalreserveeducation.org, and you'll see the stuff that we created when I was at the Fed for high school students. It's in every book. It's on TV every day. You have Jerome Powell's press conference today at 2:30 and the announcement of their policy shift at 2 p.m. today. It is everywhere. But that's also what makes it hard, because it's everywhere and you constantly can, if you want to, read about the Fed. And when it's all said and done, I don't care if you learn about the Fed and monetary policy from a comic book. And I've written comic books about the Fed. They're on the Federal Reserve Bank of New York's website, honest to goodness. I don't care if you get it from a comic book. I don't care if you get it from a cartoon, but you got to get it. Where is it best? Read your books. Go to the website of the Fed, the New York Fed, the Federal Reserve Board of Governors. The information is abundant and it's everywhere. And there's a lot for you to learn. And of course, you have to learn it. You can't come out of this course and not know that there are 7 governors of the Fed and 12 Federal Reserve banks, and the Monetary Policy Committee of the Fed is called the Federal Open Market Committee. You need to know that. If you don't know that, it's pretty hard for me to give you a high grade. So you have your work cut out for you. and I hope you will do it. Okay, ladies and gentlemen, have a great weekend. I hope the weather is good and you can enjoy it, and we'll talk again soon. Be well.
I have a question, Professor.